Hello, everyone. Thank you for joining us today for another episode of Two Economists and a Lender, where we take a deep dive into the most important economic issues facing us in agriculture. I'm your host, Carly Jacobson. Today we have David Widmar and Brent Gloy back with us from Agricultural Economic Insights, talking through the traps our brains can create when thinking through marketing opportunities. Also joining us today is our lender expert, Michael Bachman, who is not only an officer here at Farm Credit, but also works in production ag, operating a row crop and cow-calf operation with his family. And this puts him in that unique position to understand both the importance of following that written marketing plan and the emotional pull to respond to those markets. So let's get to it. Brent, why don't you take it away?
Hi, everyone. Thanks, Carly. It's great to be back with you again this month. And I'm really looking forward to this webinar because it's one of those topics that both David and I are very passionate about. And we're just very excited to talk to you about this. So let's just go ahead and get started. Decision making can be really hard. And I'm not talking, we make so many decisions as individuals all the time. We're making decisions to do all kinds of stuff. But when it comes to our business, some of these decisions can be really hard. And there's a really famous guy named Daniel Kahneman who wrote a book called Thinking Fast and Thinking Slow. And he really tried to get at this science of how people make decisions. And what he distinguished, and just to give you a background, Mr. Kahneman was such a smart guy. He won the Nobel Prize in economics, and he is not even an economist. He's a psychologist by training. So it gives you a sense for just how talented an individual he was. He categorizes it as, level 1 and level 2 thinking. And just to give you an example of that, level 1 thinking, our brain functions to make a lot of decisions really fast. An example he uses, a famous example he uses, is if you were, back in the old days and you're walking through the jungle and you heard something rustling in the bush, you ran. And why did your level 1 thinking tell you to do that? Because, you didn't know exactly what it was, but it could be a tiger and it might eat you. So you just, your brain tells you, get out of here, and you do it. And that's kind of an automatic type of decision making. But then there are other things that level 2 thinking, that level 1 thinking serves us well in some situations, but in others it doesn't serve us very well, and it leads to all kinds of decision biases that kind of screw us up, and those are the ones we want to avoid, and we're going to talk about those in this webinar today. The other type of thinking is level 2 thinking, which is kind of a highly calculated thinking where we actually step back and say, okay, I was driving down the road today and I heard the markets and I heard a guy on there say, it might go down. So level 1 thinking is, oh my gosh, I better sell. Well, that's probably not the kind of thinking we want to do on the marketing plan or on our marketing decisions. We want to step back, take a second to really cultivate some thinking, do some calculated thinking on it, and that's level 2 thinking. So as we think about decision traps, there's a really great quote from a famous physicist named Richard Feynman, and he said, "You must not fool yourself, and you're the easiest person to fool." And if we sit and think about that for a second, I think there's a lot of wisdom in that. We trick ourselves into doing all kinds of things that are probably not in our best interest, because really we can talk ourselves into doing about anything. And so as we think about how to avoid that, a 4-step process David and I like to use is we want to start, and if you think back to one of our earlier webinars on the OODA loop, observe, orient, decide, and act, it's very similar. We need to assess the situation that we're in, make sure we understand it, take in all the data we can, and then analyze that and make a decision. But after we're done and made our decision, one of the most important parts, and this is one most of us don't do because this takes the extra step, is to step back and review it and say, okay, I made that decision. Was that the best possible decision I could make? Why or why not? Did it work out? Yes or no? Why or why not? Did I make the best possible decision with the assessment of the situation I had in at the time I had it. And I think this applies to a lot of things today. I mean, if you just look around us in society, there's so much uncertainty right now. It's really hard to make decisions, and decisions that seemed right at the time might not be now the best decision that we have more data today. So I think it's really important to review those and say, well, could I have done a better job at assessing the situation, or did I not have the right data? Maybe I did, and it just turned out that it moved against me in a way that I didn't expect. And that's okay, as long as we use the right process to make our decision.
We make a lot of hard decisions as producers or as decision makers. I think what makes grain marketing and such an important one to talk about, especially in 2020 here towards the end of the year, is there aren't a lot of decisions where someone comes on the radio every day and updates the outcome, right? If you buy a tractor and you're negotiating a tractor, the salesman or woman doesn't call you every week for the rest of the year and tell you, hey, I'd take this much money for it today, or, oh, it's sold already. But on the grain markets, they're always out there almost day and night. There's someone out there putting bids out there. And that makes it really hard to make decisions. That review process that Brent talked about can get really challenging because of this constant feedback loop. So thinking with that, I want to switch over to a poll question, and we're going to talk about this feedback loop. So here in this poll, we want you to assume there's 10,000 bushels of corn to sell. Which of the following scenarios would give you the most regret? Scenario 1 is 2 weeks ago, you sold the corn for $4.15 a bushel. Today, the corn price is $4.45. The other scenario is number 2, corn prices peaked at $4.45 per bushel 2 weeks ago, but today you sold it at $4.15. So you're getting $4.15 either way, but which one of these gives you the most regret? So this is one that I'm curious to see what everyone thinks about. I know that this is something that I really think about a lot, especially in the summer, when that market rally starts taking off. I'm always, don't sell those bushels. It's going to come higher. It's going to go higher. And so I'm always worried about, missing that top. And I know Brent has a little different angle to this. So he's always thinking about the other side of it. And what we're trying to see here is pull out some sort of bias that we all have when we go in to making these decisions. This is part of assessing the situation. All right, so the results are about 60% of you are getting a lot of regret when you're selling behind the peak, and about 40% of you are worried about selling before the peak happens. And so this is one of these pieces of information that I find really valuable to help thinking about. It's not necessarily that it sends up red flags in my thinking. So when it's the summer and I'm seeing these rallies happen, and it's always busy, right? You're trying to mow hay and plant double crop soybeans or get your wheat harvested. These market rallies happen. So it's important for me to keep in the back of my mind when I'm saying, oh yeah, but it could still go higher. I have to realize that that's my bias.
David, that's the important part of it, is recognize your bias and try and do things to fight against that. So, really understand what your biases are so that you don't have all of that regret.
And here's another one, Brent, is are you feeling bullish or bearish? And this could be relevant to this month or this week, but it could also be really relevant to just your general disposition, how you sort of the glass half full or half empty sort of an outlook. And again, like Brent said earlier, it's just recognizing that as you're going into the situation, just recognizing I'm worried, I'm a little bullish, and I'm a little worried about missing the peak out. And that starts to take some of that edge off. That sort of helps reroute our thinking so we don't fall victim to some of the traps that we might be seeing. And one of the tools that we suggest a lot is a scorecard. Just stepping back, saying, what's really going on here? Where have prices been? What's the stocks to use ratio? How much information is still unknown? Or doing a pro-con list. What's the advantages of selling here? What's the cons of selling here? To help take out some of that emotion.
And David, what I think the advantage of this is it's really moving us past that type level one thinking. We're getting into where we're processing it. Have a discussion. Don't just listen on the radio to the or on Twitter to the latest information, and it biases us. You know it does, because I'll find myself scrolling through Twitter and seeing yield pictures that don't look good, and you go, oh, it's yields are really down. Well, we want to avoid making decisions based on that kind of emotional thing and really step back. Let's write some pros and cons down. Is there really good evidence besides that yields are higher or lower? And on the bullish or bearish, if you don't know yourself, ask one of your friends or maybe your family member or a colleague, whether they think you're usually bullish or bearish. And I can tell you for a fact that my father is usually bullish. Okay. And so I think understanding that, and I'm probably the other way, usually bearish. And I just had an email exchange with David last night on soybeans, and said, that's one commodity I find myself always leaning bullish for some reason. I don't know why. I've been burnt by it so many times, and so I'm trying to neutralize some of that kind of innate biasness that I have. And so I think have those conversations and write your scorecard down.
So that's assessing the situation for the baggage, right? Or the headspace that you're going into the situation. Another thing to think about is, how are we assessing the situation with the questions we're asking? And the question we get a lot is, will corn prices go higher? And that's going back to the Danny Kahneman work. That's a level one question where we all have an answer just like this. But it's a very open-ended question, and it doesn't actually help move the needle as we navigate this. And so we have this triangle of doomed uncertainty. You start with open-ended questions like, will corn prices go higher? And then you either answer them yes or no, which is very deterministic, which means you're not going to budge off that for any amount of new information, or you answer it like an economist and you say maybe or probably. And then this third step here is you never really revisit that. You never actually get a true resolution. Either you forget about it, or sometime in the future, things play out in a way that you can claim victory. There's a saying in the stock market, you pick a date or you pick a price, don't pick both. And if you pick one, you can always claim victory at some point into the future. And so flip the script on the types of questions that you're asking. Move beyond these open-ended questions. Try to assess the situation with something that's very tangible. What's the probability of me getting $4.15 for my 2020 corn crop? That's an example. That's something that you can measure. You can get feedback from your trusted advisors or your other teammates to help you navigate that. So Brent,
right. So the first step in this process to fix this doomed uncertainty is to start with a question that is much better. So as the example David just gave you, instead of saying, will corn prices go higher, let's get more specific and say, what's the probability that corn December 2021 futures price between now and say next October trade above $4.30? That is a much more specific question that we can answer and track and go back and evaluate.
So Brent, talk a little bit about the data. You mentioned this earlier, maps on Twitter. This is one that you and I both fall for. I fall for, and then you pull me out of the ditch with.
Yeah, and this is the U.S. Drought Monitor, and these are the types of information I think can be allow us to trick ourselves a lot. And so you look at that and visually you go, well, most of the United States is in drought. We can see some drought in Iowa, and certainly where I live in southwest Nebraska, it's really, really dry. And so immediately your brain is going, this was back in July, going, well, the corn crop is going to be really short. And I think sometimes we have to step back and really think about what that information is showing us, because the initial reaction sometimes may not line up with reality. And I think Charlie Munger said it best when he said, sometimes very vivid extreme evidence misleads you to the deeper reality. You have to be on guard against that all your life. In fact, the whole trick in life is to get so that your own brain doesn't mislead you. And I think these kinds of images can. So David has done some work on this to just try and dig into what is that drought monitor map situation telling you, and what do you find, David?
when we saw those maps, Brent reminded me, well, we can dig deeper, and so we did that work, and we looked at that, and I said, okay, how much of the estimated corn crop on an acre basis is being impacted by droughts? Because our eyes are trained to see red, and we saw that big red blob around the four corners region of the country, and so what was going on there? So I measured it up, and in 2020, in July, about 30% of the corn crop was in dry conditions. Another 15% was in drought. So one headline is 45% of the corn crop is in dry or drought conditions, and that's the highest for a long time, going back to 2012. But when we put enough context around this, we actually see, well, a 2012 event was more like 75% of the corn crop in drought conditions and another 15% in dry conditions. So 90% of the corn crop was doomed, right? And so that's one piece of evidence that we looked at. The other thing we looked at is, okay, let's look at these drought conditions and let's plot those with what the final yields were. And there's a downward sloping relationship here on the chart to the right, but if you look at it, 2005, 2006, 2007, and 2000, these were all years that had a big part of the corn belt, or a big part of the corn producing regions of the country, the corn acres, in drought. And they actually had above trend yields. And so the takeaway from this is that we just have to be a little careful with how we take in that information. We know at the farm level and the field level what's playing out in our backyard, but we have to be careful when we back that out and try to make big conclusions about what's happening across the entire corn producing regions. And this is true for a lot of localized weather events. Localized weather events have huge implications for the growers in that region. They can be absolutely devastating, but the impacts are traditionally limited at the national scale. Now, you put a bunch of localized events together, it starts to have a 2012-like impact, but we have to unsort what's going on locally versus nationally. So impacts are important. Maybe the basis in your part of the country are going to be stronger, but maybe not the futures price. And I think the Iowa storm here in 2020 is an example of that. There's a lot of smart people trying to figure out what were the impacts of this storm locally, which was devastating, especially if it hit your operation, but also what might be the implications at the national level. And so, the story for grain marketing in 2020 in Iowa is going to be very different. And it's going to be especially different on the basis side. The future side, maybe not the case. Here's another way to consider the implications. The recent China purchases. These are good news. They've been higher, but the USDA already had big expectations. And so we have to sort through the signal versus the noise. What's new information and what's information that's just confirming previous assumptions. Switching gears here to the third point is what I like to call the measuring stick problem. When in the literature they talk about this, the framing problem, and we get this question a lot: is $4.50 a good price to sell my corn? And well, that depends, and it depends on a lot of information. And if we're not careful, we start to use $4.50. Is it good or not based on the charts? And we might start chasing a higher price. But if we actually know our true break-evens and our true cost of production on our operation, we can flip the framing of this question and we can start making it relative to our cost of production. So is $4.15 a good price if my break-even, with everything included, family living and some estimates for debt service, if I need $3.85? Well, that starts to tell you a much different story than if you're just trying to chase a higher price.
Yeah, and I think that's an important point, David. The higher price chasing is what can lead to a lot of problems. And if we're always just going for the highest price, it's really, really difficult to do that. And you're never going to be able to hit that every year. But what we want to do is step back and frame the problem differently. Is this a price that allows me to make a profit? And I think that is a much different question. And a much more useful question, as you're saying.
So the next one is reviewing. And this is the hard one for me because you have to untangle two very tricky elements, skill and luck. And if we're not careful, we are good decision makers with bad luck. And we have to be very careful with that. And so here's an example of the seasonal price pattern for corn. And we know that on average, there's an opportunity to sell our corn crop in the summer because that's when the prices are typically highest. And then the uncertainty around the crop on average gets removed and prices start to settle. So we know we want to build a good marketing plan. This is probably going to be part of the thought process that you're doing, is that if we need sales before the end of the year to make our cash flow needs, and if we don't market some of our crop before the fall, on average, we're going to be getting a lower price than what might be desirable. But then here's the 2020 story, right? What happened in 2020? Well, the market fell out of bed pretty hard very early in the year. And then we've had this very late season rally. And so it starts to untangle. Well, how much of your marketing decisions in 2020 were the result of skill versus luck? And that's a really hard thing to wrap around, because it's really hard to untangle that.
Right. And David, I think right now I've talked to a lot of people that they're expressing some regret maybe for selling some of that commodity in the spring when prices are typically higher, and now seeing, a really, really strong rally here. And, I step back and say, did you make the best decision that you had with the data that were available to you at the time? And if we remember right, things were not good at this point. And it turned out this year that apparently the demand is a lot stronger than we thought, as well as the crop is maybe smaller than we thought. So we're seeing a very, very strong rally in commodity prices. And I think sometimes when we think about all of that stuff, it leads us to say, oh, we really screwed up. Well, no, I don't know that we screwed up. We have to make the best decision with the information we had at the time. And if you always evaluate it based on the outcome, it's just like David says, if there's a 20% chance of rain, it's going to rain 1 out of 5 days. So that doesn't mean you shouldn't go, lay your alfalfa down with a 20% chance of rain, and it rains. You say, well, I really made the wrong decision. Well, maybe not. It was really 4 and 5. It wasn't going to rain. So it just so happened this time that's the way the coin fell or the dice fell.
So we're going to switch gears now, Brent, and we're going to bring Michael in. Michael is our lender expert. So Michael, thank you for joining us. This is a topic that Brent and I really enjoy talking about and thinking about. And you have some unique perspectives, both on the production side, but also on the lender side. So I look forward to your ideas and your thoughts here today.
Yeah, no, thank you for having me. Happy to be here, and let's see what we got.
The first question Brent and I have for you, and you're going to stick around and do Q&A in the overtime section. So keep sending those questions in. I see a lot of already came in. Keep sending your questions, and we'll get to those at the end of the 30-minute mark. So the first question I have for you is, what are some common decision traps you see producers falling into?
Yeah, you bet. So putting some thought around that just over the past week, you somewhat addressed it already. It's just the data overload that our producers have access to. So with the world we live in, internet, just cell phones, et cetera, there's good data and bad data, and then it's sorting through the data, and then what do you do with it? Definitely it's easy for producers to get caught up on the trap of you jump on Twitter, and we see out in the Eastern Corn Belt, they're dry, or all it takes is reading 3 or 4 posts, and you think the whole Corn Belt's going to dry up. So having producers keep in mind that we are in a worldwide environment, and that there is, it's easy to get skewed by just the wrong data. So making sure they sort through that. The second thing is I see producers do quite a bit is maybe not having a plan for marketing, and more specifically not having a written plan. When the markets get to be full of turmoil, or when there gets to be some form of stress on the operation, it helps take the emotion out of decision making when you have that written plan. It keeps your feet grounded on what you can go back to when things are crazy around you. So definitely have a written plan to give you some guidance throughout the year. Third thing would be, so when you do have a plan, keep in mind that they are fluid, that they can be adjusted, should be adjusted, because the market around you is adjusting all the time. So if something doesn't go your way, just don't abandon the plan. Take that halftime adjustment and make corrections as you see fit. And fourthly, over the past couple of years, we rolled out of the golden era of 2010, 11, 12. We've seen maybe some times of financial stress. And when producers are stressed, they feel like they have to hit a home run on their marketing plan. And that's not the case, because when they feel that pressure, maybe they often set unrealistic goals. Maybe their targets are way too high. And then at the end of the day, nothing feels, and they just add more risk to the operation. So be cautious of not to put yourself in that trap.
I really like those are all great points. And the one that I want to sort of circle back is 2 and 3, which they seem contradictory, but I think they're really important, right? Have a written plan, but then also be willing to adjust it. Because there's 2 ways you get yourself in trouble: is no plan or a plan that you never adjust, right? That's what happens when you run into the wall, the brick wall, right? You got to have a plan, and you got to have a plan that you can make adjustments to as reality unfolds.
Yeah, it goes back to that level 1 and level 2 thinking. You want your plan to be an educated decision, intentional and proactive. You don't want to be having to react to the market on a daily basis.
So are there any other strategies that you've seen producers use to improve and try to navigate? You talked about having a written plan and being reaction. Is there any other strategies that you've thought of?
Yeah, and the good thing is there's always hope. There's always a way to better yourself. So, and I think it starts with that self-reflection. It's let's identify, when you look at your own operation, your strengths and weaknesses. And then once you do that, it allows you to start making a plan. And for some people, that plan might be seeking off-farm third-party marketing firm help. But others, it's just maybe fine-tuning their current plan or their current knowledge. So just self-education, self-development. And so much of that is when you have a plan in place, the hardest part of it is execution of that plan. So start simple, make it a slow evolution, and over time, definitely you can get better.
I know, Michael, you talked about, baby steps to implementing some of these things. Talk to us a little bit about that as well. And you don't have to go 100% all in one way at once, right?
Definitely, from a lender perspective, we want to manage risk. So I do agree with the philosophy of selling in intervals. But yeah, so if you're someone that's never done any type of forward contracting, when you look at the tools available when it comes to marketing, there's so many out there, and it can be overwhelming if you don't know what you're doing on a daily basis. So keep it simple. If you have felt like you've always just sold 100% of your grain at harvest time and never took advantage of any cash contracts, maybe keep it a simple goal of, hey, I want to be sold up to my insurance guarantee by the first week of July. So that goes back to just knowing some of the seasonal trends, but have that written plan and keep it super simple. It does not have to be too elaborate. And then as you want to evolve, you have the opportunity to do it. And then, like I said, the tools out there for marketing are so vast. So that's where you can tap into someone else's knowledge to help them be the expert.
So when a customer comes to you, because we get this question a lot, and says, what are prices going to do? How do you help them think through that?
For me, it's I spin the question back on them. It's, well, let's take a look at your operation. What does it mean to you if prices go higher? What does it mean to you if prices go lower? So it's managing the risk. If they feel like they can absorb more risk, and what you guys mentioned earlier, and analyzing where they're at, what is their bias? Are they currently bearish or bullish? So for me, it's more of, let's take a look at the facts, and then let's try to make a decision what's right for your operation. And at the end of the day, it needs to be their decision, because I want them to be comfortable with what they're doing as well.
Michael, Brent's going to do some organizing here and sort through the questions. We've got a lot of good questions this month, but I got to ask you the billboard question. So if you could put one piece of advice on a billboard here in October of 2020 for thousands of producers to see as they're thinking about the end of the year and their next plans, what would that message be?
For me, it's probably 3 simple words, just be giant words. It's know your operation. And when I say that, there's times I want producers to have blinders on. I want them to focus on what's best for them. So they need to know their break even. They need to know their cost of production. What does their marketing plan look like? What does their financial plan look like? And what is their risk management? What is their appetite for risk? Just the opposite is we see so many times producers get caught up in, well, what is my neighbor doing, or what is their neighbor doing? They're reading stuff on social media. So I want them to really focus on what's best for them, because the coffee shop talk of, well, my break even is 385 or mine's 360. That might be true, but everyone's going to be so different when you start analyzing their own needs.
That's a really good piece of advice. I always laugh to myself. Producers come and go, well, I know somebody on this side of the county is doing this, and I had another neighbor tell me that someone over here was doing that. So you start to think you have 4 or 5 data points. I'm like, I think we're all talking about the same farm. I think it's just we're so worried about what's going on the other side of the fence row, the other side of the county, that we sort of have blinders as to what's going on with our operation. So, Michael, thank you again for all your insights. And Brent, you want to kick us off with a couple of questions from the audience?
All right. Okay, we have quite a few. I'm going to start with one that came in and says, talking about Michael had mentioned, sell up to your insurance level, and somebody said, what does that mean? What are you referring to? And I think I know, but maybe since you answered it, I'll throw it to you.
Yeah, so when I start working with producers on marketing plans, I want them to also coincide other parts of their operation. So when you think of a marketing plan, how does it overlap with your crop insurance? How does it overlap with your future goals financially, growth goals, debt pay down? And then also, what is your appetite for risk? So going specifically back to this question, with crop insurance, it should intertwine with your marketing plan, because we can safely start forward contracting, whether it's on the board or cash sales, via protection that comes through federal crop insurance. So, you think of your APH, and you might take a 65 or 70% level. So it gives you a manner, if there would be a worst case scenario where Mother Nature involves or interacts, that you can still have protection, safely forward contract even before harvest. So a great tool to allow you to do that.
So in other words, let's just to use simple numbers, if you had 100 bushel APH, which a lot of you have much higher than that, and you had an 85% multiple peril policy, you'd have 85 bushels of corn guaranteed through crop insurance. So you could sell probably to that level and not worry about being short of bushels. Now, the question then is, what's the right level? And I think for every person, that's a little bit of a different question as to how high you want to go, or whether it's all the way to 85, but you can safely go anywhere from 85 below probably, and feel comfortable that, even if you don't have a crop, you'll be reimbursed for that crop to cover those contracts. So that's another way of saying, I think, what Michael had said.
So Brent, I want to take one step back from that. And we have a lot of rules of thumb or heuristics that we use a lot in this marketing space. So it's, the neighbor says, or this expert says, sell half of my APH by this, or a third by here. I don't know. Everywhere we go, they're a little bit different, but we all have those. And what's important is to recognize, we hear those, right? And the goal is not to blindly apply them. We can use those heuristics, or those rules of thumb, but we have to really understand what works best for us. And so, to your point about selling up to the crop insurance, right? What does that mean? What is my preference? What does it mean for my operation? What are the implications? And that's where it's really important to dig in more than just sort of that surface level thinking. We have to know what was going into that surface level assumption to apply that to our operation successfully.
We have another question that says, well, normally I sell up to my APH by June, July, but I've read that, in some years that isn't 40% of the years, that's not actually the highest price. And this worked well in 19, but not so well in 2020. What do I do? And I can feel your stress, and I think most of us have sold probably, in retrospect, we sold more grain than we wish we had because prices are higher. But again, I think we have to go back to evaluate that decision. Was it the best decision that we could make at the time? And I look at it and go, well, we were selling at prices that gave us, some potential for at least some profit, and the potential was clearly there to have an outcome that ended up with really bad prices, prices that wouldn't work in a budget. And if that's something you have to avoid, then maybe selling that grain in 2020 ahead of when the prices peaked, wasn't a bad decision. It just worked out such that you could have had higher prices now. It could have worked the other way as well. And I think that's the important thing to remember is that, sometimes it rains when there's a 20% chance of rain. The other thing, like one of the heuristics I use myself is I always tell myself, well, I have more left to sell. I have more left to sell because most of us don't sell all of it. So I think stick to your plan. Keep working at it, develop a plan next year. And this particular question mentions they have a lot of on-farm storage. Focus on your basis as well. Try and manage that as best you can because there's more to selling grain than just the highest futures price.
For me, this kind of circles back to the question asked earlier of which gives you more regret. I definitely fall in the camp of I always hope my next sale is higher. I'm looking at these incremental sales, long-term averages of, yes, not this individual sale, what my average is going to be. What is my overall average going to be for the year? So that's always been my attitude. And then the psychological side of this is don't get caught up and always looking in the rearview mirror. Yes, it's okay at the end of the year to reflect and review to better yourself, but don't beat yourself up because it's hard enough the way it is.
Right. So and things happen. If it were always as easy as selling in June, July to get the highest price, grain marketing wouldn't be hard. We wouldn't be having this webinar, right? So I think that's the important thing. Let's make the best decision we can with the information we have. Another question: what do I do if I sold before the market rise? I've sold grain before the market rise too, and I can tell you what I'm going to do. I'm going to sell some additional grain at the higher prices and be happy. And you can find advisors that will tell you to, go out and re-own grain. But I think then we have to ask ourselves, do we really want to speculate on that? And is that really what we're in business for? Were those sales at prices that were high enough you could make a profit? If so, I think there's always options. Always things you can do, but whether they're the right thing to do it depends on your situation.
I like to encourage this person who submitted the question to get a little tighter with that. Did you sell all your bushels or just some of your bushels? Because if you sold some of them, right, there's still marketing opportunities, like Brent said. I think the other thing to keep in mind is the market has rallied also for the 2021 crop, right? We've seen prices in that 2021 window start to move up. So I'm not saying you have to go out and make decisions today, but don't get singularly focused on the fall 2020 story. There's still a play out here that's been going on for the other marketing years as well. So we always have to be thinking, what should I do today and what are the implications for down the road? And always be thinking about updating your plans and making your plans for the future as well.
So another one, what percentage profit should we strive for above our break evens if we have no debt and can take risk? Are there actually many operations in that situation? And I guess, so one, I would say, and then maybe let Michael have a crack at that too. I think it depends on your situation and what your tolerance for risk is. And I always tell people that, it depends on your situation. I farm in a partnership, and my partners are in, a much stronger financial position than I am. They can take a lot more risk than I can, and they do. And sometimes it works well for them, and sometimes it doesn't. So I think it depends. In terms of actual percentage profit, I don't know that I have a good number for you off the top of my head. I think that's something you should think through in your business plan and put down numbers that make sense for you. But Michael, you look at a lot more financial statements than I do. Maybe you'd have a better target than I do.
Yeah, really, I'm just going to probably echo what you said. I don't have a rule of thumb for this. Definitely comes down to individual operations and individual appetite for risk. The great thing about the world we live in at technology is when we build cash flows, we can play around real quick to see what do we want to pencil in potential profit. What would that take for target goals to be set out there? And then we quickly see like, well, I wanted a 10 or 15% return, and I would take this for corn. That might be unrealistic or put too much risk on the operation. So definitely operation by operation and risk by risk. Everyone's so different. If you're an operation that is tight on working capital, I don't know that you can be too unrealistic with those goals.
And I think about it differently in terms. I don't think about it in percentage terms. Myself, when I'm thinking about my own operation, I think about it in dollar numbers. And so I can tell you what different price levels mean in terms of net income in my operation. I have numbers in there that go, yeah, that's a number we're shooting for, and I'll take a chance on that. So I kind of try and really get into at the individual level as opposed to percentages, looking at, what does that mean to bottom line numbers, cash flow levels, all that kind of stuff.
The other thing I want to add to this is what does it mean to break even? And I think a lot of times we throw that word around and we all kind of assume it means the same thing. But there is a tax bill break even, right? There is an economic break even, and Brent and I can talk about that all the time. And there's a cash flow break even. And so when you say break even, does that mean you've covered all your debt service obligations, that you've covered your family living? So you really need to think about make sure that you know what break even means, and make sure that you put in what your goals are. So maybe you've broke even, but you have a goal to build your working capital up, or you have a goal to, save up for this new land purchase. So you really have to be specific as to what that means. And it's going to be different for every operation, but you really need to get specific as to what is my break even and what does that mean? And do I still need more on top of that?
Yeah, and that's a great point. We're getting that time of year where renewals are coming up. Operations are starting to look at cash flows for 2021. And it ties back to this marketing plan. In the ideal scenario, I would love to see marketing plans be almost three-sided. A bullish marketing plan, a neutral marketing plan, and a bearish marketing plan. A lot of those what-if scenarios. And then also doing the same thing from a cash flow perspective. Well, let's plug in a bearish cash flow number for corn, a neutral cash flow number, and a bullish. That'll give you perspective on maybe how bullish you can be or what your appetite for risk really should be.
Michael, I see a question here that I was wanting to ask you, and I didn't get to it. But it goes about a third party and getting some, an expert to help us. And I guess, how do you know who the best company to work with is, and how do you go about that process?
Great question. It's something we definitely see every day working with producers. And I don't know that there is a best company out there. It's going to be a matter of who is right for your operation. There's many third-party marketing firms out there, and they're all going to have just different strategies, different appetites for risk. So from a lender standpoint, there's some great firms out there that really do a good job of digging into, well, let's tie in our marketing plan that works together with your financials and risk. There's other ones out there that will just be more like, well, we'll kind of give you advice, and then you can do with it what you want. So what I recommend producers is do the interview process. Try to get maybe 3 to 4 different firms that you might be looking at. Speak with a neighbor, get some advice from them. But then also have realistic expectations once you go through that interview process. Know if a firm's promising they're going to get you the top dollar every year, my one advice is probably walk away. But just be realistic with your goals or expectations when working with the firm. And typically, even from a lender perspective, I can give you 3 or 4 in a certain area and then let you kind of take the process from there.
Another interesting question. Do you recommend reownership on paper versus paying commercial storage or building your own physical storage? And I think it's a good question. I would say, when you're thinking about the reownership strategy versus commercial storage, we just have to remember what we're giving up if we pursue that route. What you're giving up is basis appreciation. What you're gaining is reduction in the physical storage that you're going to you're going to pay for over time. And so those are the trade-offs you're making there, I think. Is that right, David? And this is one David and I debate all the time as well. And so, I think most of these strategies can be effective either way. And again, an incremental approach, try some, see what works, what doesn't work, because there's lots of different ways to implement a strategy like that, and experiment a little bit. Take Michael's baby steps.
And think about it over a 10-year process, right? Or a 5-year process. Because I was chatting with someone today, and they were talking the other day, and they were saying, I'm looking at the futures markets and the carry, and I'm looking at the local basis, and I'm having a hard time wrapping my mind around the storage situation. But just a few years ago, it was the complete opposite scenario, right? There's a lot of carry in the market, and there are big basis opportunities. And so I think you got to step back, and sometimes you have to sort of make a decision with an expectation about the future, and use the past as your guidance, but realize just because it happened in the past doesn't mean it's going to happen the same way out. And we just can't make a decision for today based on today's reality.
I think he was talking to me.
I had a lot of conversations actually about this very thing. It's like, man, the bases are strong, and it's just sort of a hard thing to wrap your mind around.
I think sometimes we just got to keep in mind it's the KISS theory. Keep it simple, and it's okay to walk away. Just accept contentness for the time frame, and maybe not take on more risk.
Best way to lock in price floors. Again, this is something you want to talk with your marketing advisor, but there's all kinds of options to doing that. You can use options, you can use futures contracts, which not only puts in a price floor, but a price ceiling. You can use cash forward contracts. There's just a lot of different ways, and I don't think it's fair to say that one way is better than the other. There's lots of different alternatives, and you have to find the one that you're the most comfortable with. I saw one in here. I'm sure a lot of people are curious what we think about this. What's going to happen after the election? Who knows? I think that this is part of the uncertainty, right, of what's happening. But I honestly, I always say that the president is usually given too much credit for a good economy and too much blame for a bad economy. And I think our system in the United States is very resilient, and that the United States is going to go forward no matter what happens in the election. So I'm not probably as concerned about it as some. I think there could be some turmoil, I guess, so to speak, or some. There's definitely going to be some people upset either way with what happens, but I think in the long run, we'll move forward and things will be fine.
My only recommendation is to take that to something specific and tangible, right? Instead of talking about these big things sort of with ambiguity, drill it down to, is it going to change my marketing plan? What's the probability of me being able to get 425 next spring or next summer for my corn crop? What's the probability of fill in the blank, right? And I think you have to turn these into specifics. And I think when you turn it to that way, it takes out that emotion, and you start to get honest with yourself, and you can start to see how it actually moves the needle. So if you wake up after the election results, what questions, right, might you change your forecast on, or your expectations about when you wake up after the election results?
Yeah, I think that's a very good way to frame it, David, is saying, is that, if you want to say what's the probability of 430 December 2021 corn, is that going to change significantly depending upon the outcome of the election? And we all have an answer for that. Mine would be, I don't think it's going to change it that much. But other people might think differently. I'm not saying I'm right, but if I were given the weather forecast on that, I would say it wouldn't change my forecast if I had that information ahead of time too much.
And I think that's where we're at today, is if you're one of those persons asking yourself the question of being concerned that the market might change on you, going back to how we started off, be in that level 2 category. let's be intentional about our decision making today versus reacting to after the election.
Carly, I guess, is there anything else before we sign off?
There isn't, but once again, great conversations, great topics. I know a lot of this content is going to feed right into our Growing On meetings coming up here in December and January. So stay tuned for that information. But that'll do it for today for another episode of Two Economists and a Lender. So I just want to thank David, Brent, Michael. Great conversation today. Thank you for you and the audience too for joining us. And we look forward to seeing you online again next month. Thanks, everybody.